We've got Peter Tchir, who is the Academy Securities Head of Macro Strategy, here in studio with us. Peter, I'm looking to my left here. I see you've got your iPad out. You've got your tables loaded up here. So you've clearly been diving into this report over the last few minutes here as we're seeing some market reaction. I want to get your read in.
You know, one, I think it's a great number. I think it puts September firmly on pace now for a cut, and maybe even starts getting some conversation about end of July. We might need some more data. I think you hit on one really important thing, that shelter was still contributing to inflation, but it was only 0.2 this month. It's been very stubborn at 0.4, and it's one of those indicators that's known to lag. The way it's calculated has old data in. It hasn't been keeping up with anything contemporaneous, right? If you look at a Zillow or any sort of report about rent, it's been coming down faster. This is encouraging, so I think it's a good sign for the coming months. I think it's a really good report, and some of the reports we've had in the past few months, you look at the details and they're a bit sketchy. This looks pretty solid all the way around, at least on the first glance.
Peter, we have the market's reaction up right now. When we take a look at futures, yes, we are seeing this move to the upside. They have been under just a bit of pressure here ahead of this print. What does this tell us, though? It's a bit of a muted reaction, I think you could characterize this, just in regards to when you compare it to the print that we got. What does that tell us then about future upside? Do those gains maybe look like maybe they're not so significant?
Yeah, and it's interesting because I'm looking at the bond market. I think the 10 years down 10 basis points. So you had a pretty significant reaction in the bond market. The front end's even moving more. I think the equity markets got ahead of themselves. Like the last few days coming into the close, we've done very well. So I think equities are already priced in for this. Maybe the bond market, maybe we're a little bit more stubborn and wanted to see the data. So I think that's a sign that, yeah, it's going to be hard for a lot more gains. I think this puts the Fed, story intact. Now we get back to, can AI keep driving this entire market? Because until the last couple of days, it's really been so much AI stocks. It's been encouraging the last few days where you've seen the Russell 2000, the equal weighted kind of come along. And that's something I think a lot of us are looking for.
Do you think it can? Sorry.
Yeah.
Unfortunately, I still more in the view that we'll get a slight downturn in equities, even with the good Fed, and you'll get the catch up mostly because the momentum stocks will lead the way lower a little bit. It's not going to be a dramatic pullback, but that's how I see it right now. But I think it is time to start adding value, equal weighted indices to your portfolio.
I'm taking a look at some of the CME Fed Watch probability that's kind of moving around here after this report just came through. And it doesn't seem like there's too much of an outsized reaction, even for the meetings that you were pointing to a moment ago. A lot of the markets have been focused in, zeroing in on September as that first cut, and then looking out to December for a potential second cut here. But can the markets continue to see all-time highs on AI fervor alone, plus a lack of cuts potentially?
I don't think so. I think, that I would have expected 2 or 3 months ago for the small caps, for the value stocks to catch up, right? Because we were getting, okay, the Fed's going to be good, and we had decent economic data, and they couldn't rally. And right now, I'm a little bit concerned. The job market's rolling over. We're seeing some weakness there. The last report, the headline was great, but a lot of it was public sector. And I'm very concerned some of the seasonal adjustments have been missing and overstated jobs in January and February, and we're going to pay for that in the July and August numbers where the seasonal adjustments will actually understate jobs.
So that's an interesting point. If we don't see the Fed act soon, I guess how much further weakness do you think we could potentially see within the jobs market?
I think significant. When you look around anecdotally, right? Even last summer, we called last summer at Academy the summer of travel or the summer of vacation. Everyone was hell bent on taking their 2 weeks. They were doing this. It's still popular, but it feels like we're more normalized. And you look at, hotels. You can find hotels a week in advance. All these things are pointing to what we were calling. We had 2 COVID bumps, very distinct in terms of inflation and jobs. The one was goods. It was very fast. Yeah. What we saw in services was a much slower buildup and a slower decline, but we're starting to see that. So I think jobs are pulling back, spending's pulling back. Everyone's going to be a little bit cautious ahead of this election. We don't even yet know officially, I guess, who's going to be running in the election, let alone what policies are going to be on the table. So I think that's going to slow investment and capital investment, maybe away from anything other than AI, but even AI. Will people continue to put money into it right now? And if the stock market starts rolling over, it's been so momentum driven that I could see that falling off a little bit quickly. And I think you've talked about this a fair bit in the past too, but the S&P 500, 10 stocks are about 40%. So every dollar that goes into SPY, every dollar that goes into QQQ gets disproportionately put into those same stocks, and that's been helpful. Unfortunately, if we start seeing any profit taking, I think it can turn just as quickly.
Yeah, it's really interesting in what you were mentioning. I mean, we went from last summer and the summer of the women-led economy to now the summer that's really just focused around two old dudes as of right now and trying to figure out what's going to take place there. Three, if you include Fed Chair Jay Powell. No offense to him, very seasoned, very smart. But at the end of the day, you've got to think about where in the employment situation that's actually casting doubt on spending ability for a lot of consumers out there. Are you seeing significant cracks, and if so, where?
You know, I think you see some cracks at the lower end of the consumer. You're seeing some little uptick in credit card delinquencies, little uptick in parts of the autos. Nothing to be alarmed at. And again, it's really hard to judge this because we had that COVID bump, and all of a sudden everyone was debt-free. Everyone had more cash than they knew what to do with. And so some of the data has been tricky to analyze and compare. I keep trying to go back to what it looked like in 2018, and I think the labor market's slightly worse than 2018. I think the low end of the consumer is starting to bottom a little bit, to turn over a little bit. And that's where our fears are.
All right, Peter Tchir, always great to have you, especially on a day like today. Thanks so much for joining us here in studio.